Hello friends, and welcome back to Boss Economics World, the only show that tells you what the numbers are really saying while the mainstream analysts are still trying to figure out which way to hold the chart. Today, we're diving into the Midas touch madness. The headline screams, gold smashes past $3,650 an ounce. The champagne is popping in the commodity pits, your gold bug uncle is finally feeling vindicated after 40 years, and the financial news anchors are using words like unprecedented and historic. Historic? Friends, historic is what you call the discovery of fire. This isn't historic, this is inevitable. This is the fever chart of a global financial system that's been running on a cocktail of cheap debt, political wishful thinking, and pure, uncut hopium for the better part of 2 decades. So let's put on our X-ray goggles, slice through the market noise, and look at the skeleton beneath this glittering gold rush. What does a $3,650 price tag on a shiny, yellow metal actually tell us? Let's start with the surface-level story, the one they're feeding you on Bloomberg and CNBC. It's a neat, tidy little package. Gold is rallying because the Federal Reserve is expected to cut interest rates. Well, no kidding. As of today, September 12, 2025, traders have priced in a near 100% chance of a quarter-point cut next week, with 2 more penciled in before we pop the New Year's confetti. We just saw U.S. consumer prices come in as expected, which in Fed speak means not hot enough to stop us from hitting the panic button with a velvet glove. This is Economics 101, folks. When interest rates go down, the opportunity cost of holding a non-yielding asset like gold also goes down. Why would you hold a 10-year Treasury bond yielding a pathetic 2.5% when inflation is stubbornly buzzing around 3% and the bond's face value is being systematically eroded? You wouldn't. You'd rather own the barbarous relic that has outpaced the S&P 500 this year, up almost 40%. 40%! In a world of financial engineering, the oldest money on earth is running circles around the so-called geniuses in Silicon Valley and Wall Street. Then there's the dollar. The Bloomberg Dollar Spot Index is taking a weekly loss. A weaker greenback means it takes more of those green pieces of paper to buy 1 ounce of gold. Simple math. And finally, we have the financialization engine, exchange-traded funds, or ETFs. Bloomberg's data shows a flood of nearly 25 tons of gold into these funds this week alone. That's the fast money, hedge funds and retail traders piling in, chasing momentum. It's easier than ever to buy gold. You don't need a vault, you just need a brokerage app. You can buy a piece of the action while waiting for your latte. So, to recap the official story, lower rates plus weaker dollar plus ETF inflows equals gold to the moon. It's a clean narrative. It's logical. And it is dangerously incomplete. It's like describing a tsunami as a big wave. It misses the colossal, tectonic shift happening deep beneath the surface. To understand why gold isn't just having a good year, but is fundamentally repricing the entire global financial order, we need to zoom out. This isn't a story about market mechanics, it's a story about a profound, multi-decade loss of faith. Issue number 1, the central bank credibility crisis, the chickens of QE come home to roost. Let's be brutally honest. Gold at $3,650 is a vote of no confidence in the people printing the money. It's a global referendum on the Federal Reserve, the ECB, the Bank of Japan, and every other central bank that promised transitory inflation while their balance sheets swelled to levels that would make a banana republic blush. Remember the post-COVID world of 2021 to 2022? They printed trillions. The Fed's balance sheet exploded from under $4 trillion to nearly $9 trillion. They assured us it was a temporary emergency measure. Then came the inflation spike of 8 to 9%, the most severe in 40 years. They were late to react, then slammed on the brakes with the most aggressive rate hiking cycle in modern history, cratering regional banks and putting the economy on a knife's edge. And now, here in 2025, what are they doing at the first sign of a wobbly labor market? They're getting ready to cut rates again. They're reopening the fire hose. What message does this send to the world? It says the Fed, and by extension all Western central banks, have a credibility problem. Their dual mandate, stable prices and maximum employment, is a farce. When push comes to shove, they will always choose to sacrifice the purchasing power of your currency to bail out the system, to prop up asset prices, and to service the mountain of government debt. The rest of the world is watching. And they are not just watching, they are acting. The World Gold Council's data tells the story. In 2022 and 2023, central banks went on a historic gold buying spree, the largest since the 1960s. We're talking about China, Turkey, India, Singapore, and a host of other emerging market powers. In 2024, that trend didn't slow, it accelerated. They're not buying gold because it's pretty. They are systematically and deliberately de-dollarizing their reserves. They are swapping paper promises from a government with over $40 trillion in debt for a physical asset with no counterparty risk. This isn't a conspiracy theory. It's a balance sheet reality. Gold at $3,650 is the price of broken promises. Issue number 2, the geopolitical casino and the weaponization of finance. This gold rally is also a fear gauge. Our little news snippet casually mentions geopolitical uncertainties and a bizarre story about President Trump trying to oust a Fed governor. Let's connect those dots. The weaponization of the US dollar and the SWIFT system against Russia in 2022 was a Rubicon moment. Regardless of the politics, it sent a chilling message to every nation on earth: your dollar reserves are not yours. They are a privilege, granted by Washington, that can be revoked at any time. Suddenly, holding trillions in US Treasury bonds looked less like a safe haven and more like a potential liability. For nations in the BRICS Plus bloc and beyond, the strategic imperative became clear: diversify away from the dollar. And what's the ultimate asset that sits outside any single nation's political control? Gold. Look at the political landscape of our fictional 2025. Tensions in the South China Sea are a constant simmer. Resource nationalism is on the rise as countries hoard critical minerals. And in the US, the political polarization is so extreme that a former president is in a court battle over the independence of the central bank. When the world's reserve currency issuer looks politically unstable, and its financial system is used as a tool of foreign policy, the world looks for an exit. Gold is that fire escape. Every flare-up, every saber rattled, every tweet that questions the bedrock institutions of the global order adds another $100 to the price of an ounce. Issue number 3, The Great Wealth Divergence, A Tale of Two Rallies. Here's the part they won't talk about on the evening news. Who is benefiting from gold at $3,650? Is it the average person whose wages have been battling inflation for the past 5 years? No. Their grocery bills are up, their rent is up, and their savings account yields less than the rate of inflation. They're running faster just to stay in the same place. The beneficiaries are twofold. 1. Sovereign entities, the central banks we just discussed. 2. The global 1%, the wealthy individuals and families who already own the assets. A 2024 Oxfam report showed that the world's richest 1% captured nearly 2/3 of all new wealth created since 2020. This gold rally is a massive accelerant to that trend. While the bottom 90% holds their wealth in cash and homes, the top tier holds a diversified portfolio of stocks, bonds, real estate, and hard assets like gold. The very inflation that erodes the savings of the working class is what drives the wealthy to hedge with gold, pushing its price up and further increasing their net worth. It is a vicious, self-reinforcing cycle of wealth inequality. Look at the example from the article. Thai households are poised to buy more gold for a 5th year. This isn't just a quaint cultural habit. For many in emerging markets, it's a desperate act of self-preservation. They see their local currency, the baht, fluctuate wildly against the policies of a distant Federal Reserve. Gold is their personal central bank, a way to save outside a system they rightly feel they have no control over. But for every Thai family buying a small gold bracelet, a sovereign wealth fund is buying a literal ton of it, widening the gap between the asset haves and the asset have-nots. Issue number 4, The Silver Squeeze and the Search for the Next Thing. The analyst in the report, Priyanka Sachdeva, makes a fascinating point: silver could benefit if there are investors looking for a less expensive entry point. This is a classic late-stage bull market signal. When the primary asset, in this case, gold, becomes so expensive that it feels risky at these levels, the speculative energy spills over into cheaper, higher beta alternatives. We see silver, the poor man's gold, topping $42. We see platinum and palladium catching a bid. This isn't about fundamental value anymore. It's about FOMO, fear of missing out. It's the market searching for the next rocket ship. This tells you that a significant portion of the rally is no longer driven by prudent, long-term hedging but by hot, speculative money. As the analyst says, investors are more likely to trade headlines and momentum than commit long-term. This creates a paradox. The underlying reasons for gold's rise are long-term and structural. But the price action is becoming short-term and volatile, driven by financial instruments and headline-chasing algorithms. This makes the market increasingly fragile and prone to sharp, violent corrections, even if the long-term uptrend remains intact. So, what have we learned? Gold at $3,650 an ounce in September 2025 is not a story about a commodity. It's a story about a system under duress. It's a report card on central banking, and the grade is a resounding F4 failure to maintain purchasing power. It's a barometer of geopolitical fear, measuring the tremors of a fracturing global order and the decline of a unipolar world. It's a monument to wealth inequality, a glittering symbol of the chasm between those who own assets and those who owe debt. And it's a casino chip in a highly financialized market, where long-term trends are hijacked by short-term speculation. The question isn't whether gold will go to $4,000 or pull back to $3,200 next week. That's just noise. The real question is what this price is telling us about the health of the currencies in our pockets and the stability of the system we all depend on. The message is clear: the foundation is cracking. For decades, the world ran on faith in the US dollar and the central bankers who managed it. That faith is evaporating, ounce by ounce. So, is gold a safe haven? Or is it just the prettiest deck chair on the Titanic? Maybe it's both. It might keep your personal wealth afloat, but it won't stop the ship from going down. Keep your heads up, and your wallets guarded. The waters are getting choppy.